From Bloomberg World Headquarters in New York City, this is Evening Edition on Bloomberg.
I want to get back to the story behind today's market rally. What's going on? Drew Kanaly helps to manage $2 billion as chairman of Kanaly Trust Company, and he believes the bull market is here to stay. Joins us from Houston this evening to talk about that. Always a pleasure to have you with us. What gives you a sense that what we're seeing right now is not just, here, there, gone tomorrow, perhaps?
Well, Mike, rumors of the market's demise were greatly exaggerated. I mean, we never really lost the fundamental underpinnings of the market. We still have good tax policy, good regulatory policy, good tax policy, and, yep, good Fed policy. So all the market fundamentals are still in place. We just had a little credit scare, and now we're finding out credit is still available. Maybe not as plentifully as it was before, but there's still plenty of credit out there.
But with all the people out there who have hinted, including former Chairman Greenspan, that the possibility of recession was anywhere from 1/3 to 1/2, so they've projected, and that word being bandied about more and more, and simply the way trends operate, are you so confident right now that that is likely not to happen at this particular point?
Yeah, we're still in good shape. I mean, let's watch the employment numbers this week. That'll be a good indicator going forward. If we see the unemployment rate going up, it might get us concerned. The Fed also has a lot more room not only to lower rates. If we look at the 91-day T-bill, it's at 391, 393, something like that. They can go easily, 50, 60 bips more without disturbing anything inflation-wise. And also the Fed has plenty of room to increase money supply. Remember that old number we used to look at? Mm-hmm. It's been flat going back 12 and 24 months. It's been flat. So they've had pretty restrictive policy on here, so they've got a lot of room to ease.
Where in all this do you see the greatest opportunities right now, and where do you see perhaps weakness?
Well, the weakness, I mean, you don't have to tell the housing people where there's weakness. You don't have to tell the mortgage industry where there's weakness. So all that's going to continue. Remember, where a lot of this housing stuff all began is we just simply built too many houses. Then we had to come up with a financing mechanism to get our way out of it. So we still got some houses to sell. That's probably going to be this time next year that inventory gets cleared. Once that inventory gets cleared, then prices on houses start to improve again, and maybe the bid on some of this paper gets a little better subprime-wise going forward. On the good news side, foreign sales, the emerging markets are still tremendously strong. Look at the price of oil. I mean, that tells you there's still plenty of demand out there. There's a lot of good signs out there.
What though if we get into a situation where geopolitical events, as we've labeled them in recent years, suddenly change, and we go from oil in the high 70s or low 80s to oil substantially higher than that? What does that do to your basic assumption?
Well, let's think about it. If we go back to 2003, our average experience with the price of oil was about, what, 20, 30 bucks a barrel? Mm-hmm. Now, fast forward, we're up to $70, $80 a barrel, and we haven't seen a big inflationary spike, nor have we seen any real problems with productivity or profitability. So it appears to us that even if oil were to spike a little higher, we could still find plenty of profitability and growth.
The weakening of the dollar, how does that enter into your assumptions, equations, and your investments?
Well, it's good news for us if we're selling things abroad, because our products are a lot cheaper. So you can look to examples of companies that make goods and sell them abroad, from a 3M to a Caterpillar. They're all enjoying huge success. Don't forget Boeing. All these companies are benefiting from a weaker dollar.
All right, so talk to me about asset allocation right now.
Well, if we're talking about an investor that's, a 50-50, a market weight investor, we're telling them right now there's probably no harm in overweighting a little bit. So you could shade it to the 50 to 60% in equities right now and do just fine between now and year end.
And in terms of next year, I'm going to say it's a political year, but we're already kind of in a political year, but we'll be voting next year. Does that enter into your assumptions at all?
It's a huge issue. If you remember at the top of this segment, we were discussing the big drivers of the marketplace. And if we have some big policies in taxation, regulation, or trade, that's a problem for next year, and we definitely are looking for 2008 to be quite a watershed event in our portfolios.
All right, Drew, have to leave it there. Appreciate it. Wish you a lot of luck.
Okay,
Thank you. Drew Kanaly of Kanaly Trust Company joining us this evening from Houston.